Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the International Accounting Standards, Introduction and IAS-1-1 of 2. Hope you will like, share and special request to all to don't forget to subscribe our channel. International Accounting Standards. Financial statements are used by a variety of groups for a variety of reasons. The framework surrounding IAS identifies the typical user groups of accounting statements. Main users: owners, managers, investors, employees, lenders, suppliers, customers, government, tax authorities, and public and environmental bodies. Use of owners: to assess efficiency of the stewardship of management and to assess performance in relation to payment of dividend. Managers: to assess efficiency of their strategies by comparing with the previous years or with similar businesses. Investors: to assess past performance as a basis for future investment. Employees: to assess performance as a basis of future wage and salary negotiations and to assess performance as a basis for continuity of employment and job security. Customers: to assess performance in relation to the likelihood of continuity of trading. Lenders: to assess performance in relation to the security of their loan to the business and to assess the performance in relation to the payment of the interest that's finance cost on the loan provided. Suppliers: to assess performance in relation to receiving payment of their liability. Government: to assess performance in relation to compliance with regulations. Taxation authorities: assessment of taxation liabilities. Public and environmental bodies: to assess performance in relation to ethical trading. Fundamental qualitative characteristics. Relevance: the information influences the economic decisions of users. Faithful representation: the information must be complete, neutral, and free from errors. Enhancing qualitative characteristics. Comparative Comparability: the information enables comparisons with similar information about other entities and with similar information about the same entity over time to identify and evaluate trends. IAS-1 Presentation of financial statements. IAS-1 was comprehensively revised and reissued in September 2007 and applies to accounting periods beginning on or after 1st of January 2009. The objective of the standard is to prescribe the basis for presentation of general purpose financial statements to ensure comparability both with the entity's financial statements of previous periods and with the financial statements of other entities. The revision introduced some new terminology and changed the titles of financial statements. Balance sheet became statement of financial position, whereas income statement became statement of profit or loss and other comprehensive income. Cash flow statement became statement of cash flows. However, entities are not required to use the new titles in their financial statements, but all existing standards and interpretations are being amended to reflect the new terminology. IAS-1 requires that all income and expenses are presented in a statement of profit or loss and other comprehensive income. IAS-1 does not allow entities to choose whether to present income and expenses in the PL or the OCI section of the statement. IAS-1 states that unless required by a specific IFRS standard, all items of income and expenses should be presented in the PL section of the statement. IAS-1 states that the tax relating to items of other comprehensive income is either shown as a separate line in the other comprehensive income section of the statement or netted off against each component of other comprehensive income and disclosed in the notes to the financial statements. The key implication of an item being presented in other comprehensive income rather than profit or loss is that the item would not be taken into account when measuring earnings per share, an important performance indicator for listed entities. Financial statements provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. To meet that objective, financial statements provide information about an entity. Assets, liabilities, equity, income, and expenses, including gains and losses, contributions by and distributions to owners in their capacity as owners, cash flows. The financial statements must be present fairly the financial position, financial performance, and cash flows of an entity. The components of the financial statement. A complete set of financial statements as set out in the standard comprises a statement of financial position at the end of the period, a statement of profit or loss and other comprehensive income for the period, a statement of changes in equity for the period, a statement of cash flows for the period, see IAS-7, accounting policies and explanatory notes as per IAS-8. Comparative information. Accounting concepts. The standard requires compliance with a series of accounting concepts. Going concern. The presumption is that the entity will not cease trading in the foreseeable future. This is generally taken to mean within the next 12 months. Accrual basis of accounting. With the exception of the statement of cash flows, the information is prepared under the accruals concept. Income and expenditure are matched to the same accounting period. Consistency of presentation. The presentation and classification of items in the financial statements should be retained from one period to the next unless a change is justified by a change in circumstances or the requirement of a new IFRS. Materiality and aggregation. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions by the primary users of the financial statements. Each material class of similar items should be presented separately in the financial statements. This would apply to a grouping such as current assets. Offsetting. Assets and liabilities and income and expenditure may not be offset unless required or permitted by an IFRS. For example, it is not permitted to offset a bank overdraft with another bank account not in overdrafts, that is in OD. Comparative information. There is a requirement to show the figures from the previous period for all the amounts shown in the financial statements. This is designed to help users make relevant comparisons. To be continued in our next video. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.